US stock market lately is giving me an overwhelming sense of suffocation, like a spring coiled to its absolute limit, with both bulls and bears holding their breath. The moment either side blinks, an epic, face-ripping directional move is going to explode. Caught between geopolitical conflicts, Trump's policies, and the Fed, US equities are sitting at a massive historical watershed. If you look at the suffocating price action of the S&P 500 right now, it bears a terrifying resemblance to 2015. Prolonged sideways chop, moving average tightly coiled, and the real killer, the VIX term structure, has flipped into backwardation. In Wall Street quant models, that means the tug of war between longs and shorts has reached a critical tipping point. If we run the exact 2015 playbook, S&P futures are highly likely to go test 6,100. Wall Street is highly likely using this geopolitical conflict for a deep, violent shakeout, clearing the deck for the macro bull run in the second half of the year. But financial markets are never just a simple copy-paste of history. When everyone has pulled up a chair and grabbed their popcorn waiting for a market crash, the show usually gets cancelled. The 2015 dump happened because the market was caught off guard. Right now, thanks to geopolitics, retail shorts and minutes way too crowded. In times like this, the most likely scenario is a flip script. A fake breakdown to trap the bears, followed by a violent repire, executing a bloody short squeeze. Interestingly, if you look at EBC market buzz, the overall long and short sentiment is incredibly unstable right now. You might ask, how do we explain the recent tape? Look at the headlines. US-Iran conflict dragging on, the market panicking over oil supply chain disruptions and inflation rebound. And let me tell you, this is likely just Wall Street manufacturing a narrative. Historically, localized words only cause short-term emotional flashes in US equities. Once the dust settles, the market almost always rallies. Smart money is weaponizing this macro-level panic to engineer a rapid short-term flush, washing out all the weekends and over-leveraged retail float. This is the violent shakeout right before the generational buying opportunity. Why are institutions in such a rush to grab chips? Because the fundamentals of the US markets are undergoing a qualitative shift. For the last 2 years, AI has just been selling a story, but now in 2026, it's the ultimate show me the money year. Have you noticed that lately mega cap tech stocks are dumping regardless of whether their earnings are good or bad? That's because the market is immune to pie in the sky promises. Capital wants to see actual monetization and deployment. This year is disruptive. Is AI actually going to replace traditional jobs and rebuild the software ecosystem? Can Tesla successfully launch its 2 core projects? And then there is a rumored mega IPO for SpaceX. These massive industrial pillars form a long-term mode for US equities. If big tech accelerates its commercialization in the second half, inflection point for this market could fire its first warning shot as early as the April earnings season. So stop trying to gamble on which way the spring will pop. Instead, prepare your portfolio for the incoming extreme volatility. Wall Street will likely use the geopolitical crisis for a vicious shakeout, and then, catalyzed by AI monetization, kick up the next macro bull run. So don't get blinded by short-term panic. In a word, when the spring finally uncoils, you need to make sure you're riding in a car, not getting crushed under the tires.